Hello and welcome to this short video looking at the topic of hedging from a CIMA F3 perspective with Practice Test Academy. Hedging is covered in two places in the CIMA syllabus. There's some in F3 and there's some in P3. The P3 side of things is the mechanics of actually undertaking a hedge. So it's when the cash flows, working out the profits or losses and the net position, those kinds of things, the numbers themselves all come up in P3. F3, which is what this video is about, is more to do with the accounting side of things. So it's looking at the accounting standards as to how we reflect hedging transactions in the financial statements. That's what we're going to be focusing on here. Now, hedging is about removing or reducing your exposure to some kind of an externally imposed price, whether that price is interest rates or exchange rates, which are the two main ones that feature on the syllabus. But it could be the price of anything that's set globally. The price of oil, the price of gold, share prices. So, for example, if you deal in gold as a business, then you'll be very exposed to what happens to the global price of gold. And if we buy gold today with a view to selling it later, we'll be very exposed to whether the price of gold moves in between times. So hedging is all about what we can do to try and remove or reduce that risk, that exposure to that global price movement. On our exam, though, in our exam, we focus on the interest rate risk. So the fact that our profits might be affected by interest rates going up or down, for example, if we're a borrower or if we're a saver. An exchange rate. So if we trade overseas, for example, if we sell something to an overseas company, then when they pay us, if we sell to them on credit, when they pay us, we don't know how much domestic currency that's going to be worth if we're exposed to that movement in the spot rate from 1 minute to the next. So hedging is all about essentially creating a counterbalance. There are various different types of hedges that are examinable. We've got forward contracts, which are a fix. So you agree a rate, typically with a bank, but it doesn't have to be with a bank. Agree a rate for a future transaction today, whether that's a loan or whether that's selling some foreign currency or buying some foreign currency. It's for a specific amount on a specific date. You're a named party in the contract and the bank's a named party in the contract. So it's tailored to your needs and it's a fix. That's as opposed to a futures contract. A futures contract is essentially a standardized forward contract for a standard amount of something, whether it's currency or debt, on a standard date. And because they're of the standard nature of these things, they can be traded. So there are active exchanges. These things are bought and sold all the time. Options, as the name suggests, give you the right but not the obligation to do something. So rather than insisting on you buying or selling, say, some foreign exchange on a certain date, an option is giving you the right to buy or sell some foreign exchange at a certain rate on a certain date. So the good thing with options is that you only have to go ahead with them if it's beneficial to you, if you get a better rate under the option that you would otherwise get. But there is a price to pay for that. You have to pay a premium upfront, non-negotiable, non-refundable, whether you exercise that option or not. And just in terms of option terminology, a put option is an option to sell something, put it into the market, you want to get rid of it. A call option is an option to buy something. So you want to call it out of the market, you want to buy it. So for example, a put option on euros is an option to sell euros at a certain rate. Then finally we have swaps. This is more particularly to do with interest rate hedging, although it can help with foreign exchange in the context of a foreign investment. But the simplest type of swap is changing a fixed interest rate for a variable interest rate by swapping interest payments with somebody else, usually through an intermediary like a bank. So they're the various different types of hedges you could use. The mechanics of those you'll see in paper P3, as we said earlier. Now, let's have a look at how a hedge works. Now, on the right-hand side of these scales, we've got what would happen if we were unhedged. So here we've sold something to an overseas customer on credit, and in the future they're going to give us a certain amount of foreign currency. And we're now thinking, Well, the amount of domestic currency that foreign currency is worth will depend on the exchange rate when the money comes in. So if we just sit and wait, then we might, for example, make a loss of $50,000 if the exchange rate moves against us. What we're going to do is, at the time we make the sale to the customer, set up an agreement with somebody else, and this is what's known as the hedge transaction, that acts as a counterbalance. So it will create a situation where if we make a loss of 50k when the money comes in from our customer, we'll get a counterbalancing gain of 50k coming through from the hedge transaction. There is usually a quid pro quo for that, though, that if it goes the other way, once the hedge transaction's set up and it turns out we make a gain on the receipt from the customer, so actually the spot rate of exchange has gone in our favour, we've got more of our domestic currency as a result of that favourable movement. Unfortunately, the hedge transaction will take that gain away. But the whole idea is the hedge transaction is taking away the gains and taking away the losses. So it's just taking away the risk ultimately. You have to think of the big picture here and think, well, we're trying to get some certainty in the rate that we're going to get. And that means trying to remove the gains and losses. There is one small exception to that, though, number 4 on the screen there, that if it's an option, you only have to go ahead with an option if you're going to make money out of it. So the good thing with an option is you would not have to accept that loss on the hedge transaction. You would just abandon the option or walk away from it, and you could just then live with your nice $30,000 gain on the underlying transaction. But of course, remember, that's not free. You have to pay a premium up front, right back at the start, to get the right to be able to do that. Now, coming onto accounting for hedges, there are 3 types of hedges that you need to be aware of. And let's cover the 3 types of hedges first, and then we'll talk about how we account for them. First of all, there's a hedge on an existing asset or liability. So if you've already sold something to an overseas customer, for example, and you have a receivable denominated in foreign exchange, and then you take out, say, a forward contract or a futures contract to protect your position there, that's what's known as a fair value hedge. So the key word here is existing. It's an existing asset or liability, like a receivable. If it's a probable future transaction, so it's something that hasn't happened yet, like a sale next year, and you're worried about what's going to happen to the exchange rate between now and when you make the sale next year, then you might take out a hedge now. You might take out a forward contract or futures now to protect your position. But the underlying transaction, the sale, has not yet happened, then that's something slightly different, and that's known as a cash flow hedge. Then finally, something a little bit different is if you invest overseas, so you've got an overseas denominated asset, like a business or a factory or something like that, and you take out an overseas loan, so that if the value of the asset shrinks, so does the value of the liability, the loan. That type of a hedge is known as a net investment in overseas operation. Now, before hedging was ever even sort of featured in accounting standards, the standard approach was what's known as FVPL, fair value to the profit and loss. So if you had an asset that was like a receivable that was denominated in a foreign currency, you would just restate its value at the spot rate at the end of the year for the reporting date. And if you had a separate hedging instrument, except it wasn't accounted for as a hedge, if it was just a forward or a future, you would also do the same there, fair value, profit and loss. Now, a fair value hedge sticks very closely to that. So the idea here comes very much back to those scales we saw earlier on, that if you have a receivable, you fair value to profit and loss that, so you might get a 50k profit, let's say, on the receivable. On the hedging instrument, the future or the forward, you would fair value profit or loss that as well. So what you would typically end up with, if the hedge is a nice close match to the size of the underlying transaction, the profits and losses both cancel out. So the profits on one are more or less the same as the losses on the other. which is what you wanted, which is why you've done this, to sort of act as a counterbalance, to take the pain away, take the pleasure away. So that's a fair value hedge. Now you might say, well, why do we even give that a name? Because that's no different to what you would have done before. Well, say for example, if that asset was inventory. Now, normally, if the value of inventory goes up, you wouldn't normally revalue it upwards. But with fair value hedging, if you've got a hedge in place to protect the value of, say, gold that you have in inventory, and the value of gold goes up, you would increase the value of that gold on your balance sheet. But because you've made a gain there, you would also be increasing the loss you make on the corresponding hedge instrument. So again, your profit and loss account is cushioned. So it enables you to value things like inventory upwards when it's done as part of a hedge. That's a fair value hedge. A cash flow hedge, this is really trying to deal with a timing issue. If I take out some futures contracts today to protect my position against a sale I'm going to be making next year, then unfortunately the fair value profit or loss default would suggest that when I get to a reporting deadline, the end of this year, and I've got my futures in place but I haven't made the sale yet, I'm actually going to be ending up making profits or losses as I revalue that hedging instrument. And that doesn't seem to make sense, because the whole reason we took the hedge out was to avoid fluctuations in the profit or loss account. So to try and get around that and to say, well, look, this is a hedge, it shouldn't be affecting our profit and loss account. When we have the hedging instrument in place, but the probable future transaction has not yet happened, when we restate the value of that hedging instrument, we don't put it to the profit and loss account. We sort of put it in this temporary parking spot, the OCI, the statement of other comprehensive income, which keeps it away from the face of the profit or loss account. So if we make profits or losses on the hedging instrument, we park those temporarily in the OCI until we get to the year or the period where the sale actually happens. Then as that sale happens, we would then, and the technical term for this is recycle those entries from the OCI to the P&L on the hedging instrument. So what you should see happen is, let's say the exchange rate is moving against us gradually on a sale that we're making next year. Okay, by the time we get to the end of this year, the fact the exchange rate's moved against us on the future sale should mean it's moved in our favour on the hedging transaction, the hedging instrument. So what you'd see is a profit made there. Now, rather than recognising that profit in the P&L account, we temporarily park that profit in the OCI. Now, next year, when we make the sale, that sale will be at, sadly, a lower amount because the exchange rate's been moving against us on the sale. But not to worry, we recognise that sale at the lower amount, but we then recycle that profit that we parked temporarily in the OCI to bump it back up. So in net effect, what you're doing there is keeping the profit figure relatively stable. So in summary then, until the transaction happens, you revalue the hedging instrument at the reporting period end and put that entry to the OCI. Then when the actual sale happens, for example, the underlying transaction happens, then you take the entry out of the OCI and put it into the P&L. Then finally, we have net investment in overseas operations. In these situations, you never let any entries go near the profit and loss account. So every period end, you revalue both the loan and the overseas investment and put both entries to the OCI. And in theory, they should be pretty much netting out anyway, otherwise it wouldn't be a very effective hedge. So they're the three types of hedge. The first thing you need to do is to decide what type of hedge it is. And to distinguish between the top two there, a fair value hedge relates to an existing asset or liability. A cash flow hedge relates to a probable future transaction. And once you've done that, then you follow the accounting rules. Now, there have been some admittedly relatively small changes as far as affects our exam is concerned anyway. The old accounting standard, IAS 39, said that for a hedge to be accounted for as a hedge, the hedge had to be deemed to be effective, and by effective we mean the the profits on one more or less the same as the losses on the other. And the way we used to calculate that is we'd take the profits on one and divide it by the losses on the other and times that by 100 to get us a hedge effectiveness. Now, with an ideal hedge, the profits are going to equal the losses, so that's going to come out at smack on 100%. But there was a little bit of variation allowed in IAS 39. A percentage effectiveness of between 80 and 125% was deemed to be effective. If it fell outside of that, then you couldn't really say you had a hedge in place. IFRS 9, which has now replaced IAS 39, is not so prescriptive on the percentages. It still needs to be assessed and justified as a hedge transaction, but it's not so prescriptive on that 80 to 125%. So that's been removed in effect. Now, IFRS 9 is on the syllabus now. You still need to be aware of IAS 39 because it may affect things like comparatives that you're looking at in the case study, for example. Now, that's everything you need to know then about hedging for F3. Hedging for P3 is an entirely different matter, and that looks at the mechanics of how you calculate the profits and losses, etc. I hope that was useful. I'll speak to you in a future presentation. Thanks very much for listening.